Welcome back to the Bitcoin layer. China is devaluing its currency, the yuan, against the dollar again. What does it mean for global markets? Today, we're going to talk about the problems in China, what's going on from the policy response side, and what it means for the global markets and the global economy. The Chinese government has had a zero COVID policy for the last couple years, and this has absolutely stunted domestic demand. Basically, cities have been in rolling lockdowns for a couple years. This has stunted domestic demand and has made China once again completely reliant on its export economy. The second problem is the Chinese property market. So over the last decade to 2 decades, there has been a huge building boom in China, and much of it is funded through debt, and much of that debt is now in jeopardy because so much of that property was malinvestment. This means that the properties that were being built actually stretch beyond what the actual demand was for property in China. Chinese property developers are facing severe issues with their debt prices. This means that they are bordering on default in the eyes of the market. The policy response from the Chinese government makes it so that we don't see a wave of defaults and a loss of confidence across the entire Chinese capital market. Before we move on, it's very important to remember that China is still a command economy. Even though we see entrepreneurs and businesses come out of China, China and its economy is still run wholly by the government. This means that the Chinese government is able to avoid certain calamities by providing swift bailouts to whatever sector it needs to. Right now, it's the property sector. Because of the weak Chinese economy, the export-dependent Chinese economy, and the property sector in China faltering, we have now bailouts and a policy response coming from the government. The policy response is coming in 3 different forms at the moment that we want to point out. Number 1, China is lowering its prime rate. This is the policy rate. China has a couple different ways of implementing monetary policy that are different necessarily than Fed funds. China uses its repo rate and its reserve requirement, but this prime rate is one indication that China is now in easing mode, meaning it's lowering interest rates, trying to make borrowing easier. This is different than what's happening right now in the US with the Fed raising rates to try to make borrowing more difficult to try to slow inflation. China is doing the opposite right now. Number 2, bailouts. So we just saw that China is directing $29 billion to shore up the debt markets in the property sector. This is a relatively small bailout, but it's an indication that China is on standby to save whatever debt markets it needs to protect its capital market at large. Number 3, and this is the big one, a weaker Chinese yuan. So China is still dependent on exports, as we've discussed. This means that when the Chinese currency weakens, it makes Chinese goods cheaper for the rest of the world. That is what China wants now. So they are going to weaken their currency due to a weaker global economy just to make sure that they continue to support their export sector. Without exports, China growth falls, and then social unrest comes into question. Social unrest is what the Chinese government wants to avoid the most. So they are going to do anything that they can to avoid that, and that means making sure that the Chinese currency is not too strong. We have also seen that slowing global growth does correlate with the Chinese currency. So when global growth slows, we see the Chinese yuan weaken versus the dollar, as the policy response from China is, let's cheapen our currency versus the rest of the world to make our products more attractive. What is the impact on global markets? As the Chinese currency weakens, this exports deflation to the rest of the world. Why? Because when the US is purchasing Chinese products after a devaluation, it makes it cheaper in dollar terms for the US. This is a disinflationary impulse. And this is not the only cause of why the Fed is not going to over-tighten monetary policy, but it will contribute to the disinflationary impulses that we see after we've had this massive inflationary wave over the past year. A weaker Chinese currency leads to disinflationary impulses. This will contribute to the Fed pausing its rate hiking cycle sometime soon instead of over tightening because of a fear of runaway inflation. The expectation of the terminal Fed funds rate has been close to 4%, but China is one of the reasons that we don't think it'll get there. Thanks for sticking with us here at the Bitcoin Layer for this video about the Chinese economy. Make sure to subscribe to the channel, like this video, and stay tuned for more on the global economy. I want to thank my sponsors, Zebedee and Voltage. Zebedee is a Lightning Network Bitcoin company focused on getting Lightning Network powered video games into the market. Voltage is a company focused on building Bitcoin and Lightning Network infrastructure. So if you're interested in getting your own node, contact Voltage and see what they can do for you.